Good afternoon. If I could have your attention, please. Good afternoon, ladies and gentlemen. Please join me in welcoming our webcast viewers. My name is Gillian Riley, and I'm honored to be the president of the Canadian Club of Toronto and your host for today's event. Our club offers members and guests a diversity of opinions that reflect the multidimensional nature of Canada's rich democracy. Notre club offre une diversité d'opinions qui reflètent la perspective multidimensionnelle de notre démocratie dynamique. In creating innovative and relevant programming, we strive to ensure not only a diversity of perspectives, but of speakers as well. Here we offer access to dynamic political, business, and public figures. The Bank of Canada Governor is such a figure. Before I formally introduce him, here's a quick snapshot of our upcoming events. On Tuesday, January 9th, as is customary at the club, we begin the year with our 41st annual economic forecast. It will feature a dynamic panel of economic and political experts. And on Wednesday, January 17th, we will tackle the issue of unconscious bias in leadership. Panelists will address how bias impacts our decisions. Please plan to attend. To order your tickets or to learn more about the club, please visit our website at canadianclub.org. You can also join the conversation via Twitter and Instagram by following us at CDNCLUBTO or by using that hashtag. I want to express a special thanks to today's event sponsors. BMO, represented by Doug Porter, Power Corporation of Canada, represented by Paul Genet, RBC Capital Markets, represented by Jim Bird, and TD Securities, represented by Moti Jungras. Thank you for your very generous support. I want to also acknowledge the youth and young leaders table who are with us today, thanks to Scotiabank from C.W. Jeffries Collegiate Institute, and I would ask you to please stand and be recognized. They're over here. Welcome and thank you for joining us. And now our guest speaker. Members and guests, let me remind you, if you have any questions or comments for our speaker, please jot them down at the Q&A cards that have been provided at your table. What keeps you up at night? Is it fluctuating interest and mortgage rates, the volatility of bilateral relations, or the uncertainty of international markets? Do you share the same concerns of the Bank of Canada Governor? We're about to find out. The Bank of Canada, as the country's central bank, promotes economic and financial welfare of the nation. Its roles and responsibilities are outlined in the Bank of Canada Act. The bank's 4 key areas of responsibility involve monetary policy, maintaining a strong financial system, issuing currency, and funds management. Stephen Poloz has headed the Bank of Canada since 2013. As governor of the bank, he chairs its board of directors and is a board director of the Bank for International Settlements. Mr. Poloz joined the Bank of Canada in 1981 and held several senior positions, including the role of Chief of the Research Department. He departed the Bank of Canada in 1995 to serve as managing editor of BCA research publication, the International Bank Credit Analyst. He then went on to serve in several executive roles at Export Development Corporation, or EDC. He was president and chief executive officer of EDC before being appointed governor of the Bank of Canada. Mr. Poloz, we're delighted and honored to have you at today's podium, and I'll turn over the podium to you now. Thank you.
Well, thank you very, very much for that warm welcome. It's absolutely wonderful to be here. It's great to be back in Toronto. Grew up just down the road in Oshawa, which of course all of you think is a famous place. And was a Leafs fan my entire life until now. Still am. Anyway, this holiday season, like ever, is it's traditionally a time to reflect on the events of the past year and to take a look ahead at what might be in store for next year. Certainly, speaking from a purely economic perspective, I think we can look back at 2017 with considerable satisfaction. And 2018 is looking very positive too. The Canadian economy is on pace for about 3% growth this year. That would be the strongest among the G7 economies. Most sectors and most regions are now participating in that story. Over 350,000 full-time jobs have been created so far this year. Wages have recently shown signs of picking up. This is supporting robust consumer spending. Exports and business investment have long been the laggards in our recovery story. Encouragingly, though, business investment has grown for the past 3 quarters in a row, and the government's infrastructure program is becoming increasingly evident in the data. Now, in contrast, exports, they've not been stellar. They started this year very strong, but they faltered during the summer. Nevertheless, the most recent data show a broad-based upturn again in exports, which supports our forecast that after we look through all of this noise, exports will continue to be pulled along by rising foreign demand. And that all brings me to inflation, which is our policy anchor. Inflation spent the year within our 1% to 3% target band, although it has tended to be a little short of the 2% midpoint. We did a lot of work this year to satisfy ourselves that our fundamental understanding of inflation remains valid, and it does, once you take account of short-term effects in the data, the noise. Now, I've talked before about the process of bringing the economy back home. That's at the intersection of full capacity and 2% inflation. Our return home was made even longer by the detour we had to take when oil prices collapsed back in 2014. But today, we find ourselves quite close to home and getting closer, with the economy now running close to full output and inflation expected to be around 2% later in 2018. So that's all good. But as an economist, and particularly as a central banker, I find myself preoccupied with a number of slower-moving, nagging issues that I expect will be with us for a long time. They keep me awake at night because I wonder if we've done all that we can to address them. And I've chosen 3 of these things to talk about today. Now, these personal preoccupations, they're a little bit different from the more pressing, immediate risks to the economy that economists usually think about. So I can assure you that the bank is fully engaged in a wide range of such issues, from the effects of technology on inflation, to uncertainty over the future of NAFTA, to the response of housing demand to mortgage rule changes, just to cite a few. I'm not trying to spoil everybody's holiday cheer. Okay. Rather, what I've found over the years is that issues that appear daunting, they often become less so if we understand them better. And what's more, a better understanding of the issues helps everybody, from the various government authorities to the public at large, determine what should be done to resolve them. Besides that, a problem shared is a problem halved, as my dad used to say. So with that, let me share with you 3 things that are keeping me awake at night and bring you up to date on developments surrounding them. So the first issue I want to touch on is the potential for a cyber attack that leads to a major disruption. Excuse me, it's choking me up already. Sorry, excuse me. Well, I'll start that one over because that was not intended. The first issue I want to touch on is the potential for a cyber attack that leads to a major disruption of our financial system. Now, people take for granted the efficiency and convenience of today's financial system, as they should. It wasn't all that long ago that your choices for making a retail purchase were a check or a credit card or cash. And cash was only an option if you remembered to get to your bank branch before it closed. Now, I know some of you aren't old enough to remember that, but I certainly am. Well, today, e-commerce is pervasive. People can have electronic access to their accounts instantly, almost anywhere. And the infrastructure that underpins our financial system is a public good. It's every bit as important to the health of Canada's economy as our roads or bridges or airports. Now, I'm not exaggerating about that. Every day, Canada's major payment systems process millions, literally millions of transactions, large ones and small ones, and billions of dollars are changing hands. Now, these transactions happen today so routinely and with such accuracy that it's easy to overlook just how critical these systems are. The process looks completely risk-free, but it isn't. And to be without these systems for any length of time could have a significant impact on our economy. Our financial system is as good as it is today because of the major advances in communications and financial technology, and because of the high degree of connectivity between institutions. However, this connectivity also creates a vulnerability. It means that a problem in one institution can easily spread to others and be amplified. And as such, a successful cyber attack on one institution can become a successful attack on many. Now, these attacks can be launched from anywhere and spread across global networks. Now, the good news is that all the major participants in Canada's financial system are taking this threat very seriously. They're collaborating with each other by sharing information and best practices. And as for the key payment systems that connect everyone together, the Bank of Canada has the legislative authority to oversee them. Now, we ensure that they follow strong risk management practices, including those aimed at preventing cyber attacks. But we're also collaborating with partners in the federal government who are working to ensure that Canada itself is resilient to cyber threats. But we can't assume that our financial system is immune, despite best-in-class cyber defenses. We need to be prepared to recover our systems should a cyber attack succeed. So the bank is working closely with our financial institutions and payment systems to ensure that we have robust joint recovery plans in place. Further, the bank is making significant investments in its own operational redundancies. We're increasing the resilience of our systems and, of course, of our people. So it's vital that we be able to fail over quickly so that our key functions will be maintained in the event of a major disruption, regardless of the source, whether it's a cyber attack or a natural disaster or some other crisis. And to me, this is a matter not just of operational continuity, but of maintaining confidence in the financial system in stressed situations. So the bottom line is, I'm confident that we're doing everything we can on this issue, but still, the system may be only as robust as its weakest link, and that keeps me thinking. So my second preoccupation, that's the state of Canada's housing markets and the associated level of household debt. I'm sure you're absolutely amazed to hear me mention this. The bank said in last month's financial system review that these vulnerabilities are showing early signs of prospective easing, which sounds good. But these vulnerabilities are elevated and are likely to remain so for a very long time. Remember that it took years for these vulnerabilities to build up in the first place. It's not just the amount of debt, it's also its composition and its distribution. So more than 80% of household debt is composed of mortgages and home equity lines of credit, or we fondly call HELOCs. And increasingly, mortgages are being combined with HELOCs to the point where some 40% of all housing-backed loans are blended with a HELOC component. Now, HELOCs have been a very convenient tool for many households. They give borrowers flexibility to finance renovation projects or handle emergencies, such as when your furnace dies on a cold February night. And their popularity shows how useful these lending arrangements are. However, there are some potential risks that borrowers need to manage. Now, HELOCs usually allow the borrower to pay only the interest on the loan each month, leaving the principal amount unchanged. Indeed, about 40% of HELOC borrowers are not regularly paying down their principal today, which means that debt loads may persist much longer than in the past. Now, furthermore, some may be using their HELOC to speculate. For example, to fund a down payment on a second house with the intention of flipping it. Now, given the potential for volatility in house prices and for higher interest rates, such activity may be adding to the overall vulnerability of our financial system. So we've seen several rounds of macroprudential measures to tighten up on mortgage finance rules. Now, these include measures last year that were aimed at high ratio mortgages. Those mortgages where the down payment is less than 20% of the value of the home. And since those measures were put in place, there's been a sharp drop in the number of highly indebted Canadians obtaining these mortgages. And by highly indebted, by the way, we have in mind people with a debt-to-income ratio that's in excess of 450%. But we've also seen an increase in low-ratio mortgages with risky characteristics, such as extended amortization periods. New lending guidelines for low-ratio mortgages will come into effect next year, and they should too work to limit the number of low-ratio mortgages going to highly indebted households. Now, these mortgage rule changes will help build up the resilience of the financial system gradually over time, because each new mortgage will be stress tested to ensure that the borrower can manage a higher interest rate at renewal time. And it's important to remember that the purpose of these rule changes is not to control house prices. Ultimately, the laws of supply and demand will determine the direction of house prices. But at the same time, there is very little doubt that these rule changes will mean less growth in our housing sector. Now, in the wake of the global financial crisis, ultra-low interest rates have helped our economies weather the storm. But an important byproduct of that policy has been exceptional growth in housing. Now, for some time now, we've been expecting a rotation away from housing and toward other engines of economic growth, such as exports and investment. And we're seeing signs of that fundamental rotation now. So a key issue for the bank, then, is understanding how people will react when they're told that under the new rules, they don't qualify for the mortgage that they would like. Bank staff examined the data carefully from new mortgages issued last year, for 2016, by federally regulated lenders. So we took every loan, every mortgage that was granted last year in our data set. They found that about 10% of low-ratio mortgages, so around 36,000 loans, representing about $15 billion worth of borrowing, would not have qualified last year under this new stress test. Of course, there's more than one way for people to respond when they're told no. The most likely response, I think, is for people to look for a less expensive house with a smaller mortgage so that they qualify under the new rules. Others, though, might try to boost their down payment or just delay the purchase until they can. People might also look for a lender who is not bound by these new mortgage rules so they can avoid facing the stress test. And no doubt, certain non-federally regulated lenders will step up to compete for that business, although other regulators may choose to impose the same guidelines. In any event, to those people who hope to avoid this rule, I offer this advice. Testing yourself to make sure you could handle your mortgage payments if interest rates were higher at renewal is a really good idea, whether it's a rule or not. A bit like wearing a life jacket in a canoe, right? Why did they have to make that into a rule, really? But one final issue related to indebtedness. We expect that high debt levels will make the economy as a whole more sensitive to higher interest rates today than in the past. Now, this issue has obvious implications for us, for monetary policy, so we've done a lot of work this year to enhance our models to capture it. And as we said in our October monetary policy report, and again in our interest rate decision last week, this is one of the key issues that we need to monitor in real time as we consider the appropriate path for interest rates. And my third long-term preoccupation is the state of our labor market, specifically how hard it has been for so many young people to find work. Now, I mentioned earlier that more than 350,000 full-time jobs have been created this year. However, only about 50,000 of those have gone to young workers. A decade ago, the proportion of people aged 15 to 24 participating in the workforce peaked at almost 68%. And that figure hit a trough earlier this year, nearly 5 percentage points lower. And that's the lowest in almost 20 years. Now, if we could return the youth participation rate to its level before the global financial crisis, more than 100,000 additional young Canadians would have jobs. Of course, this is not only a problem for youth. We all know of people in all age groups who are working part-time when they would prefer a full-time job. We also know people who can't find jobs that match their skill set, so they're underemployed. And we know there are people who have lost the job they held for many years when their factory closed, and they face extreme difficulty in finding new work in a similar field. Now, these are all serious concerns. But I wanted to concentrate today on young people for whom a long period of unemployment can leave a scar that can last a lifetime. Now, I know there are legitimate explanations for why more young Canadians are staying out of the labor force. Enrollment in post-secondary schooling has increased in recent years, and we expect some of this rise will prove to be permanent. Some of these folks are looking to gain the skills that will match what employers are demanding. Well, there are more than 250,000 job vacancies in our economy today. That's the highest on record. Canadian business leaders tell us that most of these vacancies are unfilled because they can't find workers with the right skills. So let me suggest that responsibility for addressing this skill mismatch rests with all of us, not just the students and the education system. There surely is room for more ambitious on-the-job training programs in this picture. Now, this issue is taking on greater urgency because the economy is now reaching the stage where more efficient job matching and increased workforce engagement will be the main means of building new economic capacity. With more economic capacity comes the opportunity for more non-inflationary growth, a permanently higher level of Canadian GDP, and more income for everyone. Now, clearly, that's something worth having. So let me just elaborate on that. Right now, we're at a point in the economic cycle that I've often described as the sweet spot. We know that a majority of Canadian companies are running flat out. They may have been hesitating to invest in additional capacity until now, perhaps because of lingering economic uncertainty, given what we've been through, or concerns over the future of NAFTA, for example. But despite these uncertainties, companies are moving to expand their capacity now, which augurs well for the future. Now, most expansions of capacity have two elements: more capital equipment and more people. And attracting the right people to new jobs may require higher wages. And this in turn can cause people who have dropped out to re-enter the workforce. And we may be seeing early signs of this happening. I mentioned earlier that measures of wages have turned higher over the last couple of months. And in November, the participation rate for young people jumped back over 64%. So these are encouraging signs, but it will take a while before they become trends. And the bank is watching these indicators very carefully just now, for they'll help us manage the risks that monetary policy faces at this point in the business cycle. Now, our current policy setting clearly remains quite stimulative. With the economy operating near potential, a mechanical approach to policy would suggest that monetary policy should already be less stimulative. However, as we said in last week's interest rate announcement, we still see signs of ongoing, albeit diminishing, slack in the labor market. Fundamentally, this is an exercise in risk management. The fact that the economy is operating near its capacity and that growth is forecast to continue to run above potential together pose an upside risk to our inflation forecast. At the same time, though, our belief that there remains slack in the labor market poses a downside risk to our inflation forecast. So given the unusual factors at play, the bank is monitoring these risks in real time. The term we use for this is data dependent. That's instead of taking a mechanical approach to policy setting. So there we have it, 3 preoccupations that are keeping me awake at night. I could give you lots more, by the way, but those are my top 3, and I know you don't have all afternoon. But actually, there is one more thing. One more thing keeping me awake at night that perhaps is worth mentioning, and that's all the noise I keep hearing about cryptocurrencies, especially Bitcoin. Now, there's a lot of hype around Bitcoin. Markets are evolving quickly to allow wider access, including to retail investors. So perhaps you'll allow me to make a couple of points. To begin with basics, the term cryptocurrency is a misnomer. Crypto, yeah, but currency, no. For something to be considered a currency, it must act as a reliable store of value, and you should be able to spend it easily. These new instruments possess neither of these characteristics, so they don't constitute money. So what are cryptocurrencies exactly? Well, characteristics vary widely, but generally speaking, they can be thought of as securities. The Canada Revenue Agency certainly agrees, and what that means is if you buy and sell them for a profit, you have income. And that needs to be reported for tax purposes, just in case any of you young folks aren't paying attention to that. So what their true value is, of course, may be anybody's guess. So perhaps the most that one can say is that buying these things means buying risk, which makes it closer to gambling than investing. To be absolutely clear, I'm not giving investment advice. I never do. All I will say to people intending to buy a so-called cryptocurrency is that you should read the fine print and make sure you know what you're getting into. The Bank of Canada does not regulate these instruments or their markets, just as we do not regulate traditional securities or their markets. But a question that does preoccupy me is, what does the arrival of cryptocurrencies mean for the cash in your pocket? Supplying the Canadian dollars that you need to carry out your day-to-day business is one of the bank's most important mandates. It's often forgotten that the cash provided by a central bank is the only truly risk-free means of payment. With cash, buyers and sellers can be certain that the payment is final. This is an absolutely vital public good in any economy, and has always been provided by the central bank. All other payment types, whether debit cards or credit cards or checks, work through intermediaries in the financial system. Of course, they're safe, but fundamentally, they can never be quite as risk-free as cash. So just ask yourself, if you were concerned that an imminent cyber attack was about to hit the financial system, wouldn't you want to carry some extra cash till everything was back to normal? That's what I mean. Nonetheless, it's natural that transactions using electronic payments, such as debit and credit cards, continue to grow in volume and value relative to cash. And it's certainly possible that the demand for digital cash could grow over time. If so, there could be very strong arguments for the central bank to provide it, given its obligation to fulfill the public good function of money. Bank staff are exploring the circumstances under which it might be appropriate for the central bank to issue its own digital currency for retail transactions. All central banks are researching this, and we'll have more to say about the subject in the months ahead. But now I am ready to conclude. Cyber threats, elevated household debt, youth underemployment. These are all long-term issues that will continue to be major preoccupations for myself personally and for the Bank of Canada. I hope I haven't spoiled your festive pre-holiday mood by talking about my preoccupations, but in case I have, let me just repeat that the economy has made tremendous progress over the past year and is close to reaching its full potential. We are very encouraged by this, and we're growing increasingly confident that the economy will need less monetary stimulus over time. Nevertheless, a number of uncertainties remain around our outlook, many of which that I've touched on today. And as Senior Deputy Governor Carolyn Wilkins said in an important speech last month, it's critical that we take these uncertainties on board in our policy making. So allow me to repeat what we said in our interest rate announcement last week, which is that we will continue to be cautious in our upcoming policy decisions, guided by incoming data in assessing the economy's sensitivity to interest rates, the evolution of economic capacity, and the dynamics of both wage growth and inflation. And by sharing my preoccupations with you today, I hope I've also raised your understanding of them so they appear somewhat less daunting. And the bank will continue to work on these issues while doing our part to help bring about a strong and stable economy. That's been the Bank of Canada's role since the very beginning, and it will remain our role for years to come. So let me wish you all the best for the holidays and for a prosperous 2018. Thank you.
So, thank you. Before we do a formal thank you, we have a few questions for you.
Okay.
So, I didn't write these.
I bet.
What challenges do you see presenting themselves for Canada in the next 5 years?
5 years. Okay. Well, I think probably the most fundamental things will be around our relationship to the rest of the world and whether we operate in a free trading system where growth is moving everybody together, or whether we become more fractured. I think that's an important distinction for Canada because we are so trade dependent. Without a robust trading system, our standards of living would certainly be at risk. So to me, that's the one that comes to mind as a longer term. Because even if, I know everybody's a little concerned about the future of NAFTA just now, but it's more about the underlying thinking that goes into and how companies react when things change. There are many, many ways for companies to react and for consumers to react, and so it's inherently an unpredictable thing. So it becomes an uncertainty problem, which affects business investment and the long-term sustainability of our economy. So that's probably enough. I'll leave that. That's my big one.
Okay, this is sort of a follow-on to that.
Oh. Next question.
I've noticed a lack of the T word in your remarks, Trump that is, no concern from our neighbor to the south.
Yeah, well, of course, for the past year, we've had all kinds of concerns on that front, and we continue to watch the situation carefully. It's very hard to formulate a forecast or to even analyze something that you don't know what it would look like. So, frankly, I kind of park that and say, well, when I understand what things we face, then we'll worry about them. But for now, it's just sort of something we watch like everyone else.
Fair enough. What are your hopes for the Canadian dollar in 2018?
My hopes. Okay, so I would say.
I said I didn't write them.
Yeah, so, but we're in a phase right now which is not that atypical, but it's one in which the Canadian dollar is a highly respected currency, both for funding and for Forex. And I think that you know, that's what I'd like to see continue. That is that markets have faith in what we're doing, and we're continuing to be an asset of choice for global investors. Okay, there's an aspiration.
Yeah, perfect. And here's a positive question.
Okay.
What is the most valuable thing, physical or otherwise, that Canada possesses right now?
Well, that's actually pretty easy, because it's people. So I mean, we have, you know, this vibrant, you know, immigration-fed kind of population, which has always been that way. You can tell from my name, you know, that's how I got here. I mean, it's just always been that way, and I think it's what's made Canada different from almost everybody else. So everything we do to create value, it's people. It's not going to be, you know, of course we dig stuff out of the ground and so on, but it's the people that make it come to life. So I'll stick with that. That's my choice.
So I'm going to close them here because there's a lot more questions here about cryptocurrency. And I think you addressed that. A lot of people are interested in the Bitcoin. So thank you for that. And I'm going to do a little thank you for you now.
Thank you.
On behalf of everyone here today and the Canadian Club of Toronto, Mr. Poloz, thank you for sharing the things that keep you up at night. They definitely resonated with us. There was a commonality of issues and challenges that many Canadians share. Our nation enjoys the enviable position of having a strong, stable economy, a thriving democracy, and a welcoming spirit, and you talked about the people. The Bank of Canada's influence has a lot to do with the stability of our nation. Your leadership as Governor of Canada's central bank has helped to keep inflation in check while maintaining an attractive climate for investors. As we look to the future, we are confident that you will continue to use your expertise and influence to tackle the issues that keep you awake at night so that we can all have a good night's sleep. We wish you much continued success as Governor of the Bank of Canada. And on a personal note, he gave his entire address off his iPad, which I was quite amazed at when he described he gives all his speech that way, and I myself am now being challenged to do everything on my iPad starting this afternoon. Before we conclude, I would like to thank MediaEvents.ca, Canada's online event space, and VVC for live streaming today's event. To learn more about the club, please visit us at canadianclub.org. I would like to once again thank our sponsors for today's event, BMO, Power Corp of Canada, RBC Capital Markets, and TD. Thank you again. This is our final event of 2017. Have a safe and joyful holiday season. May the new year bring you peace, happiness, and success, and we will see you in 2018. Thank you.